All right. Good morning, everybody. So it's FOMC day, obviously. I'm sure at some point today, I'm going to hear somebody say, wow, what was that big move? Where did that come from? But I got to say, I'm not seeing it as often as I used to see it. So maybe we're doing a better job of warning people that are newer to trading about these different economic events. I'm going to add something to the briefing. Just I'm going to pause my screen there for a second. You can take the time to screenshot that. It's spot gamma's daily levels. It only takes a moment, all right, for me to do that. And you have them. Don't have to worry about it for the day. So we did get a reasonably decent recovery in crude and Brent. Kind of this bear flag or a bear pennant maybe forming down here. I got a strategy called a failed bear flag. And I found it when I was trying to recognize, when to not trade a bear flag on the idea that if it is not going to continue lower, then it failed and it's going to reciprocate and come back up to these previous highs. This is primed for a bear flag failure. It would be a breakout of this IX10 pattern down below. And when I built the strategy, I didn't know about that Rob's machine gun pivot reversal concept, but it ties right into this. If we were to get a breakout, we'd want to think about, everybody who went short on these red days and where their stops would be if they were short. Their stops would very likely be above the candle on the day that they went short. If we trigger into those stops, it'll add to the buying, which adds to the push and adds to the breakover and pushes the market up towards this triple top up here. I don't think we're done with the lows in crude and Brent, but we had a really good defense down here and we've built a solid base. It would not surprise me to see a break to the upside. And if we do trigger into that machine gun reversal pivot, then we could reclaim this entire move, at least back up to 77.50 in a single day. It's kind of the idea behind it. That's why it's such a great setup. And this one is actually priming close to a TRB setup too. So yeah, take what we can get. Asia closed really well. Nice expansion. Still inside the box. But, I got to say that was a nice move on the day for Asia. Hong Kong still open, or Europe still open. It's 11:30 over there. Inside candle and stalled, which is what we would expect on an FOMC day, a market doing nothing, waiting on the Fed. And that's exactly what this looks like. Same thing with our own markets. If we were to zoom in, a market on pause, waiting on the Fed with no expectation of really doing anything until the Fed comes out with their numbers. Every Wednesday, unless there's a holiday or some other thing that throws it off, we get EIA inventories. They're worth watching. They tie right into the inflation debate. Not the inventories, more of crude. So it's worth watching this. Last year, they depleted the strategic petroleum supplies, and there's still a discussion on, are they going to restock it? When, how much, and then the size of the inventories. So data worth keeping track of. If you want to participate in some trading with this, you could use USO, if you don't want to use the CL futures, which the CL futures they're big. It's $1,000 a point. So, it's kind of a little scary. But you could use USO. It's an ETF. More than liquid enough. It'd help if I have that started. I was messing with indicators this morning and I froze up Thinkorswim, so I shut it down to reboot it and didn't get it rebooted. All right, so the reversal yesterday started at noon and really started to galvanize when we got through the open, the RTH open. So that proved to be a significant resistance level till we finally made it through. But by the time we got into a new high a day, we were already in that last hour and not really interested in trading in there. FOMC week, sideways, choppy, kind of what we'd expect. The expansion was a little bit of a surprise in the afternoon, but really still within the realm of, we haven't really gone anywhere. We have an expansion beyond the previous week's high, and we're maintaining it. Yeah, this really narrow IB this morning. There's really no expectation that we're going to do anything until FOMC. So, just like yesterday, we could expand some and kind of, gyrate around a little bit, but the big deal is going to come at 2 o'clock. So at 2, they're going to release the statement, which the algos will go through and price will move, reasonably decent. And then at 2:30, Powell's going to come out and start talking, and then the market's going to move again. And I mention this because if you haven't really traded FOMC, the first move that we get at 2 o'clock isn't always the move, right? So it could drop hard and fast at 2 and then rebound and rally right back up to where we started by 2:30, and by 3 be moving in entirely different direction. So, it's certainly has the capacity to make a lot of points in a trade, but you're going to need wide stops and just be ready to ride like a wild bronco. None of these pivot points or levels are going to matter when it comes to the FOMC today. It will crush and run through anything. So open, high, low, close, floor pivots, none of it's going to matter. ADR, gamma levels. So with that in mind, maybe do it a little different today. I always got to get this screen in. So EIA 10:30, FOMC announcement at 2, press conference at 2:30. So we're looking at 4.5% to the top of this zone, which gets us up to 4,200. Back here in 2022, when we had FOMC and we finished off the week, right? FOMC's on Wednesday, Thursday into Friday, and then we came into a whole new week, and we made this run over the next month and a half, and there was another FOMC in the middle of it too. But really, everything had started to change on those June lows. And over the next 3 market months, so market month is 20 days, and this is 61 days. That's 18%. And it still topped out. We hit major moving averages and, took a significant rejection there. Then the October lows. It's another 16%. Less than 2 months. This one was a little odd. It came in with Bank of Japan working with the Fed. There was intervention, yield control on their side, a whole lot of things. And it was a massive must save level, right? So it was like, well, if they don't come in and really pick this up, then we're going to completely leg down into a whole new lower zone. And they did. They came in and saved everything, and everybody was so bearish, and the portfolios were all set to continue a short move, and this rebound kind of just chewed everybody up. Now, we're not at the lows, we're not at must save levels, but we are about to see a complete shift in economic policy. And not the 25 basis points that they probably come out and hike with, but what they talk about going forward, right? For May, for an example, are they going to pause in May or hike more in May? So we're looking for forward guidance. And the market pulled forward a whole year of rate cuts in the last 2 weeks. So they've really accelerated the Fed's timeline. And if they aren't hawkish enough today, this market's going to explode to the upside. We're going to hit 4,200, no problem. So they got to come out at least somewhat hawkish, and they have to be believable. Powell tried to be hawkish last time, and he wasn't very believable. So 4,200 to the upside. It wouldn't take much from the market to just completely ignore Powell or misread him, consider his statements less hawkish than they had anticipated, and pop us up to 42. And with all the ratio charts and everything else still looking really bullish, that would kind of tie into the discussion of an upside move. 42, maybe even 43 if we start thinking about April and getting closer into May. All right, so some 4,300 strikes are still going to cost you, at least out in April, about $600. So if you're trying to, go all the way out to April to buy these things, you would probably want to use the 4,300s just to keep your costs less than 1,000. If you're looking at the 2,000 strike, 4,200 strike, excuse me, it's about $1,700. And the puts are going to be even more expensive, right? So we haven't even got to that side yet, but trying to use April for a longer term trade, you're very likely going to want to do a spread. And once you start working on a spread, well, then you can bring it in some. There's no reason to go that far out. Now, these are way overpriced, and this is probably a really great example of that. We're out of the money a long ways. We have a $200 expected move, higher or lower, between now and the next 30 days, and we're sitting at 4,000. So going to 42 matches this perfectly. That would be considered a normal move, not even an outsized move. And it's still pricing in risk 1 to make 4. So that's pricey. The idea behind it is if you take something like this and we do get that big move, say in the next week, you could roll this forward into time, bring it, say, 9 days to expiration, and it would already be beyond 20, maybe 30% profit by doing that. Because the ones in the front end are going to move a lot faster than the ones farther out where we are. So when you roll into the front, since those front ones already have made gains, if we do get a big move up, you would be able to capture those gains in the roll. So I moved forward to 15 days to expiration. April 6th. There's no April 7, so must be a short week. Don't think I really like that. Let's use the 14th. Well, liquidity is shot. There we go. All right, March 31st. At least we got something in there. $250 just straight up buy a call. That's not too bad. A lot of open interest on that 4,200. So for the cost of this, just straight up buy it. It gives you a chance to defend it instead of starting with a spread. A spread will make this a lot cheaper, but there's not as much defense if we don't go up and you need to kind of manage this losing trade. You won't have a lot of choices to manage it if it's already a spread. If you start naked, just a single leg option, and it needs to be managed, you've got more choices. But to convert it into a spread, $5 wide, 25 cents. So if you're wrong and we don't get that big move, you're out $25. That's not a bad risk right there, right? You're risking $25 for a chance to make $350. Realistically, it could make $475, but that'd be max profit, and it's unrealistic that you're actually going to get a max profit, right? So use a more realistic profit target, say 300, 350. That's not a bad return for risking $25. You can get more than one of these. That way you can fade the exit, take a little bit off at a time. But we built it really narrow. So the idea would be, okay, well, what if we spread it up a little bit? Widen it some. $10.40. You know, realistically, that could make seven and a quarter. For risking 40 cents, that's not a bad return. So this is $25 wide. So 4,200 to 4,250, and you're still less than $1 risk. And now you've really widened the trade enough to expose it to a lot of different gamma changes. I kind of like that one personally. I want to keep that. Now, these numbers won't be exactly what you see as we come into the open, because it's still based on where price was last night. And even though, the futures haven't really moved anywhere this morning, there's still decay and everything else. So these numbers won't be spot on perfect, but it'll be pretty close. So it's a March 31st, $25 wide call vertical for 90 cents. There's nothing really tricky about it. No, ratio to butterfly or broken wing fly or anything like that. But when it comes to butterflies, putting a butterfly on at 4,200 is not a bad idea either. It's 5 cents. I think, you know what I mean? Like it's crazy, super cheap. Now butterflies have a much lower win rate, and that's why they're cheaper. Newer traders get hung up on win rate. They want to win all the time, but winning isn't the goal. Making money is the goal. And if you hit a butterfly, the payout is massive compared to what you risked. So the goal is to get a little bit of edge so that you can increase the win rate of a butterfly beyond its 20% win rate. Even just getting it into 30% win rate is a major coup. So I widened this out 25 points. It's $60 in debit. It shows the max payout at 2,400. Again, that's not a realistic number, but something closer to, say, 1,600, it's not out of line, especially if we start making a move in that direction really fast. And for that to even start to be profitable, price needs to land somewhere within that yellow box right there. If it lands anywhere in there, you'll see profit. Maybe not max profit, right? Max profit would be pinning right at 4,200. But you would see some profit. The trick is with the butterfly, though, if we get there really fast, there won't be any profit there, right? That's one of the things that makes butterflies so hard. So say, today POW comes out and it just explodes the market and we get there in 2 days. Well, it sucks for you with your butterfly because while it might have gained a little bit of profit, it won't be very much. It's a time-based trade, so you really do need time to go by. So I like that one. It's 9 days to expiration. It's less than $1. It's $25 wide. I like it. That's a good one. I'm probably going to put that one on today. The other one is, what about this Friday? We actually can get all the way up there this week. This says we have an $80 expected move between now and Friday, and we're at 4,000. So using this, we could go to 40.80. I say that's a really low, unrealistic number. We can move 80 points in the morning session. We've easily been moving on a day-to-day basis 1.6, 1.7%, right? That's the current ADR. All right, yeah, average daily range 1.4% right now. So the fact that it's saying that we can move $80 by Friday When this says we've been moving nothing less than $60 a day, we can easily hit that $80 mark. So 40.80, those are $900 options. I say go out to 41.80. Those are 80-cent options. Split the difference, run the mid. You're looking at 70 cents for a call. And again, a naked call that can be defended if we don't go up. If we go down instead of up, this can be defended. Probably not very well because it's so close to expiration and there's not a lot of things you can do with something when it's this close to expiration. But you might be able to, say, sell a call for half of this risk. It's not bad. If we were to turn it into a spread, $5 wide, 10 cents. So, kind of like, why go $5 wide? Let's target some better open interest, 41.75, which makes sense. Those quarterly numbers tend to get more strikes, more trades. So we get some open interest at 41.75. And let's look at 4,200, another 25-point wide spread, 35 cents. Oh, I missed it. Hold on. 40 cents. So you could get two of these for the cost of one of those March 31s. Having more than one gives you a chance to fade the play. All of this discussion so far has been, what if we go up? So we kind of want to flip that over and also look at, what if we go down? On both of these, you could just buy the call, by the way. The calls weren't very expensive. You could just straight up buy the call. But I like to do the spread on the idea that we can make it a really, really wide spread and it's still not very expensive. So 3,800 is the obvious first target to the downside, and those puts are going to be expensive. I can tell you that already. We're going to have to use a spread on the puts, even at 38. So for this Friday, since we're already in that area, yeah, compared to the calls, I mean, 165, that's not that bad. 167. You can't fill for 167, so I don't know why it even shows you that, but whatever. $5 wide, 15 cents, really low risk. So of course we want to widen that out. Look at the open interest, try to identify, right, where other participants are at. We're pretty set on the 3,800, which has a lot of open interest, no problem. I'd say drop down to 37.75, and it's got some players. 60 cents, $25 wide, put debit spread for 60 cents. It's not that bad. Now I know somebody's probably thinking, well, heck, that's cheap. I could just put both of them on. You could. But if you're thinking, I'll put both on and one of them is going to hit, that's not exactly true. You could still lose on both. So if you're going to try to get cute and run both sides, just keep in mind, you can lose on both sides. You're not guaranteed that either one of them is going to hit. I put on both before in the FOMC. I think it was November, and both of them paid me because we had CPI right before FOMC. We moved big on CPI and I closed one with profit. Then we had FOMC the next day. We moved big in the other direction and I closed the other one with profit. That's not normal, by the way. It felt really good, but I think it was more luck than anything else. So this isn't bad right here. And if you're willing to up the cost a little bit, what I would recommend is if you're willing to put more money at risk, go closer to price. $25 is more than wide enough. There's really no reason to go like 50 points wide, still using the 3,800. So if you're willing to say risk another 50 cents, abandon that 3,800 and start moving closer to the money. It will cost you more money to do that, but you'll be moving your entire position closer. So your break even is closer. Everything is closer. Right. And that's just, I'm just throwing it out there because I know that 60 cents is nothing. Right. I mean, I don't want to lose any money. But in the grand scheme of things, $60, it's not going to keep me awake at night. March 31 for the puts, it's 9 days out. Got that 3,800 still with a lot of open interest. $45 for a $5 wide spread, 50 cents. That's not bad. For the for the $25 wide spread, you're looking at $2. That's a little more than this other one, considerably more. Yeah, even dropping down to 37.50 didn't fix anything. All right, that's a little better. So they say price takes the elevator up and jumps out the window to go down. So if we hold to that logic that we're going to go down faster than we go up, and that by March 31st, we could make bigger moves to the downside than we would have in an upside move, we could consider using strikes that are farther out of the money. So we can kind of keep the cost near the same. Instead of the 3,800s, we can look at the 3,700s. There's still open interest, so that's not really too much of an issue. $0.80 on the call side when we went to the March 31s, it was 90 cents. So we're just a little less than that, but we're keeping everything in the same kind of range. Now these are copy and paste links these green underlined links. I'll put them in the video description. And you can just copy them and then bring them into your Thinkorswim and paste them, and it'll build the trade for you. You don't have to rebuild this trade. If you've never done that before and you're looking at your Thinkorswim chain and it looks like this, and you don't see the spot to paste anything, no matter what name you're on, I'll just go over to Apple. It doesn't matter what symbol you're on. Just open up the options chain, click on anything so that this box pops up. And there's the paste button. So you can just copy and paste. It'll change to the right symbol, and then it will build it for you. Just make sure that you unlock it after you paste it, because in the middle of the day today, price is already going to have changed, and you might be able to buy this cheaper. It might be more expensive. I don't know. But if you leave it locked, then you're looking at it at where I copied it, right? You're not looking at it in its current cost. So just unlock the darn thing after you paste it. All right, there's 2% moves on the Qs. It just helped us out and put them all into place for us. We're averaging around 1.7%. So in 3 days, we could make a 2% move just using some napkin math, right? So say once a week, we could easily take out one of these lines. March 31st, 2 weeks out, it's 2 lines up. You're going at 322 to the upside, or 297 to the downside. It's not that bad, not that big of a range. Now you can focus on, the expected move here on the side, but that, like we just saw on the ES and the SPX, it's understated right now drastically. So, this says you can move $11 between now and the next 9 days. $11 higher, $11 lower. I say they're really understating the move right now. So, feel free to go beyond that price if you're considering the move that we could get over the next 2 weeks, 3 weeks. Remember that it seems to be a foregone conclusion that we're going to get 25 basis points today. Today's not really the issue. It's what is he going to say about the dot plots that they watch and their forward guidance for May. That's going to be the really big deal. You want to start thinking about these charts from the perspective of what are we going to do between now and May? When we get close to the next FOMC meeting, it's going to be the same as this time, right? We get close to May's FOMC, and the market's going to quit moving around. But until we get close to that May 3, right? Say a week out, week and a half. Between now and then, if we get bullish, we're very likely going to keep that bullish bias until, you know, 2 weeks away from May, to that May deadline. And if we turn bearish, it's going to be the same thing. The April 21 expiration using the cone of probability gives us 336 to the upside and 295 to the downside. $336, $285 using April 21st expiration. So something to consider on that too, right? All right, so we got the 10-year kind of popping up this morning. Again, it's not going to matter, right? Because whatever he does for FOMC, it's going to throw all of this out the window. It's why we didn't do like a regular morning briefing. Because we can go through all these levels, but at the end of the day, it's just going to come down to their statement today. So hopefully this was, a time well spent. I know not everybody's an options trader. Really be looking for that capital rotation. The idea that not today, but into Thursday and Friday, that we might start to see a rotation out of those reflation trades. And otherwise, guys, watch the news, be careful. Have a good day, and I will see you all tomorrow.